Welcome to my video. I'll trust you'll find it helpful and informative. Please remember to like and subscribe. Thank you.
So this is how the question is asked. It says the budgeted information for two business opportunities that Pitco is currently considering investing in is as follows. The first thing that you need to look at is, or you need to notice, is that in the case of opportunity one, it is based on 4,000 units. In the case of opportunity two, though, it is based on 40,000 units. There is a difference, and that will make a huge difference in your calculation. So now they say to you, they give you the sales. Okay, so the sales is the same and the cost is the same. Okay, so now you're thinking, so why on earth do I even need to compare it? But you need to compare it because the fixed and the variable cost will change based on the fact that it's based on different units, and so these underlying costs will be different. So let's have a look at opportunity one. You have direct material, 150,000, and direct labor, 157,500. Then you have fixed manufacturing overheads, sales commission, and fixed admin cost. And the same on the other side. Now, please notice that I'm just going to say that I'm just going to add something here for you as a little note that you can do for yourself. So here you have fixed cost and you have variable cost. And it is important that you are able to identify what is fixed cost and what is variable cost. So the fixed cost, let's mark the fixed cost in yellow. Why not? Okay, so here we have fixed manufacturing overheads. It's a fixed cost. Okay, here we have fixed admin cost. It's a fixed cost. Direct material is obviously a variable. Let's make that green. No, that's a terrible green. Don't that green. Then at least you can still see. No, you cannot see a thing. Okay. Sorry, just click on something else. Enter. Yo. Nobody's ever going to see what I'm doing there for you. That green. Okay, that's better. Okay, so direct material is a variable cost. Direct labor, because they say it's direct, is a variable cost. And sales commission is a variable cost. Okay, so just take your highlighter and mark that immediately when you see that question in the test. Okay, now it says we can complete the cost analysis. Now in this particular case, they have listed the material. They didn't say to you whether it is a variable cost or whether it was a fixed cost. I put this in myself. Okay, so now if we go and look at opportunity one, we know that direct material is 150,000 because they have given it to us. Okay, but we must now calculate the variable cost per unit. And that is why we go here and we see, okay, it's based on 4,000 units. So I can take the 150,000, divide it by 4,000, and then I see that it's got an effect of 37 Rand 50 cent, 37 Rand 50 cent per unit. In the case of opportunity two, my direct material was 105,000, and I had to divide it not by 4,000 but by 40,000, and it's got an effect of 2 Rand 63. The direct labor, you do the same. You take your direct labor, okay, as it is given, then you divide it by the 40,000 to get the variable cost per unit, and you get 39 Rand 38. Since the amount for direct labor is the same as for direct material, with opportunity two, you are going to get the same answer if you divide it by 40,000. Manufacturing overheads and fixed admin costs are fixed costs. So you are just going to put it in there as it is given. It is not dependent on the number of units. Sales commission, again it is. Okay. Your total sales commission is 35,000 based on 4,000. So your salesmen actually get R8.75 for each unit that they sell. On this side, the salesmen only get R1.75 for each unit that they sell. But your total cost in terms of sales commission is a lot more. So if you have the same amount of salesmen, it's actually better for these guys to be with opportunity 2. Okay, and then you add them up, and now you can start doing the calculation. So now they say to you, calculate the break-even point in units for both opportunities. Okay, but we first have to calculate the sales price. Now, the sales price per unit in the case of opportunity 1, okay, would be the 750,000, which was the sales given, divided by 4,000, which is the number of units on which opportunity 1 is based, and it gives us R187.50. Okay, our gross profit per unit will then be that 187,050 minus the variable cost per unit that we calculated when we completed the table. And so our gross profit is 101.87. And now we know that our break-even point in units, and this is the formula that you must know, is our fixed cost divided by our marginal income per unit. And that marginal income per unit, marginal income and gross profit, I've said to you many times, is the same thing. Okay, and you calculated it. Okay, so your break-even point is your fixed cost. Your fixed cost, you have calculated it. It's a 315. Your marginal income per unit, you have calculated it there. It's 101.87, and it gives you 3,092.17 units. But you cannot sell 0.17 of a unit. Okay, so you must round it up. When it comes to units, we always round up, and you round it up to 3,093 units. The same now for opportunity B, opportunity 2 rather. You take the sales price per unit by taking the total sales, the turnover, and now dividing it by 40,000, and your sales price per unit is R18.75. Your gross profit per unit is that R18.75 minus the R7.1, which is your variable cost per unit, and you get R11.74. Your break even per units then is again your fixed cost, which you have calculated, okay, divided by your marginal income per unit that you just calculated there, and then you get 32,155.03. But even if it's just 0.03, you cannot round it up, down, because if you round it down and you sell 32,155 units, you're just not going to break even. So therefore, you must round it up to the next unit, which is 32,156 units. Okay. Now that you have calculated, now just please, when you do this calculation, please note that while in the real world you have to round up for the units, when you now calculate the break-even point in sales, you must bring back that decimal, okay? Or else your rand amount is going to be slightly wrong. And just now, the person who actually did that programming for the ICB didn't give you a range, and then you're going to be wrong. So bring back the decimal, of the units that you have to sell to break even and multiply it with what? The selling price per unit. So your break-even point in sales will then be your sales price per unit multiplied by the break-even point in units that you've calculated, and that gives us 579,782 for opportunity 1. And then for opportunity 2, we bring back the decimal again. It is 32,155.03 in units, multiplied by the sales price per unit, which is 18.75, and then you get 602,907 for opportunity 2. Okay. Now, because your break-even point for opportunity 2 is slightly higher, well, it's actually considerably higher than for opportunity 1. And remember, both of these have the same sales and the same cost of sales. That didn't change. Opportunity 1 will therefore be slightly better because you reach the break-even point a little earlier. And sometimes they might ask you to motivate that, and then that is what you will do. Okay. So, you guys are now completely ready on your own, really, because just the numbers will change, to complete both assignment 2 and test 2. You have all the information that you need, and I am actually going to ask you to complete the online assignment 2 and test 2 then for next week.
Thank you for watching this video to the end. If you found it valuable, please subscribe and like.